Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on all of these occasions on our heritage.org website. I would ask our guests here in-house if you'll be so kind as to courtesy check your cell phones that they've been turned off as we prepare to begin. It's always good when our speakers are doing that, too. We, of course, remind our internet viewers that questions or comments can be sent to us at any time, simply emailing speaker@heritage.org. And, of course, we will post the program on the Heritage homepage for everyone's future reference. Hosting our discussion this morning is Norbert Michel. Dr. Michel is our research fellow in financial regulations in the Thomas A. Rowe Institute for Economic Policy Studies. He studies and writes about housing finance, including the reform of Fannie Mae and Freddie Mac, and he also focuses on the best way to address difficulties at large financial companies under the so-called too big to fail problem. Before joining us at Heritage, he was a tenured professor at Nicholls State University's College of Business. He had previously served as a tax policy analyst here at Heritage and with the global energy company Entergy. Please join me in welcoming Norbert Michel. Norbert?
Thank you. Good morning. Welcome everybody here. This is the third in the series of these monetary policy speaker events that we're having. We have several more in the works over the next few months as well, so hopefully you'll come back for those and bring many, many more friends with you. Monetary policy, of course, is one of the key components of our economy, and throughout history there have been quite a few incidents that have been sort of entangled the institution in charge of U.S. monetary policy, the Federal Reserve. Two that stand out are the Great Depression in the 30s and then its recent cousin, the subprime crisis that some people call the Great Recession of 2008. What's striking is that the debate over the Fed's role in those two incidents is very similar. Essentially, was monetary policy too loose for too long, thus contributing to the crisis? And then was it too tight at exactly the wrong time, making everything much worse? After all these years, the debate is essentially the same. Was it too tight? Was it too tight? Was it too loose? Does the central bank perform well in managing the economy this way? So at the Heritage Foundation, we're engaging in this debate head on. Aside from producing our own original research, we're having this series of events like this one. And we hope to have many more experts come and discuss the Federal Reserve performance over the next few months. So today's event with Professor Sumner highlights the central debate in a very big way, as those of you who know him already know that. Dr. Sumner was one of the only people at the beginning of the subprime crisis to argue that Fed policy was actually too tight. And that was something that seemed counterintuitive to a lot of monetary economists and a lot of economists in general. So he started a blog to discuss that issue itself and what he termed the endlessly perplexing problem of monetary policy. Dr. Sumner's added a great deal of insight to this debate, and depending on who you ask, he basically started or at least what some people are now calling the market monetarist school. So Professor Sumner has taught economics at Bentley University for the last 30 years. He earned his bachelor's at the University of Wisconsin and his PhD at the University of Chicago. He's well published in top journals in econ. He's written extensively on monetary economics as well as the role of the gold standard in the Great Depression. And what's gained a great deal of attention in the last few years anyway is the one idea that we've got him here today to talk about, which is nominal gross domestic product, or NGDP targeting. And it's basically a type of monetary policy rule. Many conservative economists, many reform-minded economists agree that some sort of rules-based policy would produce better macro outcomes than the full discretionary framework that we have now. But exactly which rule we should have is a little bit of sort of a source of disagreement. And Scott has argued that a very good policy rule would be one that targets nominal GDP growth. So that's why we've invited Scott here today to talk about NGDP targeting. And after his presentation, we will have some time for some questions and answers. So first, please help me in welcoming Professor Scott Sumner.
Thank you, Norbert, for the kind introduction, and thank you for inviting me here. It's always good to talk about these ideas. I think the best place to start is to point out that nominal GDP targeting, which I'm actually not going to get to for about 15 minutes or so, is something that interestingly has sort of bipartisan support in the economics community. So there have been a number of economists, George Selgin is a good example, who've talked about this over the years, and Bennett McCallum's another prominent, you call right-of-center economist, that has done so. But recently, a lot of sort of economists on the left or center left have endorsed nominal GDP targeting. And so I see this as not a particularly ideological proposal, but as a pragmatic solution for monetary policy, sort of making it so monetary policy does less damage or the least amount of damage possible. Now, before I get into nominal GDP targeting, though, I'm going to spend some time talking about the crisis period, my perception of what actually happened, which I think is different than how most people on either side of the spectrum view the crisis. And I'm going to argue that if you look at it this way, it makes the case for nominal GDP targeting much more powerful. I'm going to argue that a lot of people on the right have misinterpreted the recession. It's possible that money was too easy in the period leading up to the housing bubble, but I don't think that's really the primary cause of the recession. And that's one argument I'm going to make, even if in retrospect it should have been a little bit tighter. It wasn't easy enough that you could really explain something like the Great Recession as resulting from that. We've had much more expansionary monetary policy in other decades, other recent decades, higher inflation rates, higher nominal GDP growth rates, without being followed by this kind of crisis. So I think we have to look a little deeper. As far as the name market monetarist, obviously this is a nod towards the traditional monetarists like Milton Friedman, and unfortunately he passed away in 2006. But I believe if he were alive today, he would be sympathetic to at least some of the ideas I'm presenting today. Not all, certainly, but at least some of the key ideas. And so that's something to keep in mind. Now, this is a quote I like that'll hopefully get you in the right frame of mind to be receptive to what I'm going to claim, from Ludwig Wittgenstein. So I can read it, I guess. Why do people always say it was natural for man to assume that the sun went around the earth rather than the earth was rotating? His friend replied, well, obviously because it just looks as though the sun is going around the earth. And Wittgenstein responded, well, what would it look like if it had looked as though the earth was rotating? All right, and I'm going to ask you to consider over the next few minutes what the last 6 years would look like if the market monetarist interpretation was right. And I'm going to try to claim that it would look exactly like it has played out. Okay, very different from what you might have assumed. Now, this is more the consensus view. This is from Robert Hall, very prominent macroeconomist. Very first paragraph of a sort of survey article discussing the crisis published a few years ago. And what struck me when I started reading this article is that the first 4 sentences seemed almost entirely incorrect, and incorrect in kind of an interesting way. Let's start with the first 2. The worst financial crisis in the history of the U.S. and many other countries started in the 29. The Great Depression followed. I don't think that's accurate. The severe financial crisis that occurred about that time actually occurred in 1931. There was a major international financial crisis. Now, why am I so picky about the dates? Because I would argue that a more reasonable interpretation is that the Great Depression caused the financial crisis of 1931. So he's reversing causality. The huge plunge in prices and incomes and output during the period from 1929 to 33 led to some of the bank failures, the international currency crises and so on, international debt crises. Second 2 sentences, the second worst struck in the fall of 2008 and the Great Recession followed. Actually, the Great Recession began about the beginning of 2008. And more importantly, it intensified about the middle of the year in 2008. Now, unfortunately, GDP data is only available quarterly, but macroeconomics advisors estimates monthly GDP by looking at the components that they build it out of. And so these monthly estimates show that real GDP took a real significant plunge between June and December of 2008. So I'm going to refer to this 6-month period again and again over the next few minutes, because I think that's really when the key mistake was made, between June and December of 2008. Even in early 2009, the economy got a little bit worse, but most of the decline took place in late 2008. Now, the crisis that Robert Hall was referring to took place after Lehman failed in September of 2008, and especially in October and November, the international banking crisis got quite severe. I would argue that that crisis was partly caused by the Great Recession, much like the earlier 1931 crisis was caused by the Great Depression. Now, to be fair, I'm not suggesting that all of our financial problems were caused by the recession. So, for instance, the subprime problems developed earlier and really reflected other problems with our banking system, which I would argue is due to moral hazard and inept regulation and so on. But the intensification of the crisis, and it got much worse in the second half of 2008, I think was due to macroeconomic policy errors. Now, if you look at nominal GDP, you see almost an identical pattern. Peaking in June, and by December, most of the decline took place. And I believe nominal GDP is the best indicator of the stance of monetary policy. So this is an indication that monetary policy was too tight during this period of time, and the fall in real GDP was resulting from essentially an excessively contractionary monetary policy. Now, this is where I have two big problems convincing audiences, and whether it's an audience of non-economists or economists, the same problem I run into. Two things. People think it's crazy to suggest that monetary policy, rather than the financial crisis, caused the Great Recession. And they think it's doubly crazy to claim that monetary policy was contractionary during 2008, when the Fed was cutting interest rates and towards the end of the year pumping money into the banking system. So we have to look at those objections as well. Oops. Now, the number one textbook of monetary economics in the U.S. is written by Frederick Mishkin. He's sort of a moderate, well-respected economist at Columbia. He served on the Federal Reserve Board. And it's interesting that he summarizes his views on monetary policy and makes 3 points that he believes were very important, and yet I believe were almost completely ignored in 2008. The first one is that it's dangerous to associate easing or tightening of monetary policy with a fall or rise in short-term nominal rates. In other words, low interest rates don't mean easy money. And yet, when I started blogging, and partly the reason I started blogging is all I was seeing in the media, the Fed has very low interest rates, therefore money is easy. And yet we've been teaching our students exactly the opposite over the recent decades. Let me jump to the third point. Monetary policy can be highly effective in reviving a weak economy, even if short-term rates are already near zero. Again, everything I was reading in early 2009 when I started blogging was, there's nothing the Fed can do, interest rates have already been cut close to zero. So it really struck me as odd that we've been teaching our students this for years, but even many mainstream economists didn't seem to believe what was in the textbooks. And I think the truth is actually in the textbooks, and we were reacting to the crisis in a sort of irrational way, especially in the intense period of late 08 and early 09. Now, just as an aside, recently in the newest edition, Mishkin removed the phrase highly from the third one. Now it's just effective. My theory is all these community college teachers around the United States were complaining because they were telling their students that monetary policy is ineffective at zero rates, and the students were saying, but the textbook says the opposite. So they complained probably to Mishkin, and he was probably pressured to water that down a little. At least that's my own theory. Someday I'll have to ask him what happened there. Oh, back up one. Other asset prices besides short-term debt instruments contain important information about the stance of monetary policy. In the next few minutes, I'll show you that almost every other asset price was signaling extremely tight money in late 2008. Here's Milton Friedman making sort of a similar point to Mishkin. Low interest rates are generally a sign that money has been tight. And notice the past tense there. He's not saying it's always tight at the moment interest rates are low, because it's true, if you cut interest rates on that particular day, you've eased monetary policy. Friedman would agree with that. But what Friedman's really saying here is if you've had in the past a period of contractionary policy, what it'll do is it'll drive an economy towards deflation or recession or depression, and those economic forces will result in low interest rates. So when interest rates have been low for an extended period of time, like let's say Japan in the recent decades, it's because they pursued deflationary monetary policy, not because they have a very expansionary monetary policy. Again, this is very different from the newspaper interpretation of what goes on with monetary policy. Okay, and notice the last phrase there. I thought the fallacy of identifying tight money with high interest rates and easy money with low rates was dead. Apparently, old fallacies never die. Unfortunately, he wasn't alive to instruct us on this recent crisis, but I had this sort of same feeling that I was really surprised to find in 2008 and 9 that a lot of my colleagues didn't agree with me as to low interest rates not being a good indicator. Now, some of my colleagues will say, oh yeah, that's true. Nominal interest rates are not reliable because inflation. Certainly, if you have hyperinflation, you have high interest rates, that doesn't mean does not mean tight money, right? It means easy money if you have hyperinflation, yet interest rates will be high. So they accept that, but then they'll say, but surely real interest rates are reliable. In fact, real interest rates are also not reliable, but what really interests me is most of them had never bothered to look at the second half of 2008. If you want to look at real interest rates, between July and the end of November, the real interest rate on what's called a TIPS, that's a treasury bond that's indexed to inflation, went from a little over 0.5% to over 4%. That's one of the sharpest rises in real treasury yields ever seen in a short period of time, 5 months. So if economists really believe that, no, it's real interest rates that mattered, they should have been complaining about extremely tight Fed policy in the second half of 2008. Apparently, they weren't paying much attention. Commodity prices, here's another indicator. They fell in half in the second half of 2008. Obviously, that's not an expansionary monetary policy. The value of the dollar rose about 15% against other currencies on average in the second half of 2008. Now, here's what makes the dollar especially interesting. A lot of people will tell me, you know, whenever there's a big banking crisis, it's inevitable you're going to have a long and deep recession. And there's a book by Rogoff and Reinhardt that cited some data to this effect. Actually, it's not inevitable, but it does often occur. But one thing that they overlook is most of the world's financial crises were very different from the U.S. case this time around. In almost every case, the currency will depreciate sharply in the teeth of the crisis, whether it be the Mexican peso, the Thai baht, the Russian ruble, whatever. You see those currencies fall sharply. Here's the dollar right in the teeth of our post-Lehman Brothers crisis, appreciating strongly. Has this ever happened before where a currency is appreciated strongly in a financial crisis? Yes. The dollar in the early 30s was appreciating against other currencies like the British pound. And Argentina around the turn of the century had a contractionary monetary policy, and they were tied to a rising dollar. And so the Argentine currency was actually rising against most currencies around the world, and Argentina had deflation. Interestingly, those two cases, Argentina around the turn of the century and America in the early 30s, are now viewed by most economists as contractionary monetary policies. So I believe someday there'll be a reevaluation here. Other asset markets, stocks crashed in late 2008. Commercial real estate prices, which had held up for the first 2 years of the subprime debacle, when it was concentrated in housing mortgage problems, started going down when nominal GDP fell. Residential real estate in states that didn't have a bubble, like Texas and a lot of heartland states, started to fall in price only in the second half of 2008. They fell much earlier in the so-called bubble states like Nevada, California, Arizona, and so on. Tip spreads indicating inflation expectations fell very sharply in late 2008. This is one of the most amazing quotes I found in my years of blogging. So I've already given you Mishkin and Friedman. Here's the head of the Federal Reserve, but here's Ben Bernanke talking before he was head of the Federal Reserve, when he could freely speak his mind. And notice he's saying the same sorts of things. Money growth and interest rates are not reliable indicators of the stance of monetary policy. Same sort of things you get in Mishkin well, Friedman would not like interest rates. He might go with money supply. But then Bernanke ends up at the bottom saying we need to look at indicators like nominal GDP growth, I bolded that, and inflation. Now, why do I like nominal GDP growth better? Inflation can affect either demand side factors, excessive spending, or supply shocks, bad regulations, energy crisis, whatever, which also could be inflationary. But those are actually two very different types of inflation with different effects on the economy. So nominal GDP growth is really the one that gives you the best indicator of whether monetary policy is too expansionary or not. Even though if you average these two, and this is an important point, the 5 years after mid-2008, if we simply average these two that Ben Bernanke said are the right indicator, we had the tightest monetary policy since Herbert Hoover was president. The tightest since the early 30s. Now, Ben Bernanke during this period was saying that monetary policy was extraordinarily accommodative, meaning expansionary. And I think in fairness, I personally like Ben Bernanke. I think he was trying to do a good job. He's not really free to speak his mind as an academic could when he wrote this. Probably within the Fed, he had some disagreements with people and so on. But what's interesting to me is if you look at what he said as an academic, it's exactly the opposite of what he said as chairman of the Federal Reserve. And I don't know if he's changed his mind or if he just wasn't able to speak completely freely. Anyway, one counter argument I get is that, well, these low interest rates, though they're not a sign of a weak economy or low inflation or whatever, they're caused by just recent Fed policy, all the QE, buying all the government bonds and so on. But one thing I would point out is that long-term real interest rates have been declining for many decades. I don't know all the reasons why, but I suspect it probably has something to do with the fact that not just in the US, but globally, the trend rate of real GDP growth seems to be slowing, perhaps for a number of reasons. And that may have nothing to do with monetary policy. These are real interest rates, by the way, going down from 7 to 10 range in the early 80s to close to 0 on the 10-year bond today. So it doesn't seem like it's just something that began with this crisis, but it's part of a longer-term trend. Unfortunately, this graph is out of date. I couldn't find a more recent one, but what this shows you is the rise in the amount of debt outstanding, and the blue line is the amount that's purchased by the Fed. Now, in fairness, since it's out of date, the QE3 program would have pushed the blue line up to about here, somewhat higher. But the red line is also rising as we run deficits every year. So even though the Fed has bought a lot of debt, the amount that the Fed doesn't own, the Treasury has to sell to the public, is still increasing a lot, that red area. So it's not the case that interest rates are low because the Fed is buying all this debt and the government doesn't have to sell it to the public anymore. But that's a common perception out there. Another argument I get is that this was just a bubble. We had a real estate bubble, it burst, and that's the end of the story. There's all kinds of problems with this. First of all, bubbles are actually very hard to spot or even to define. What exactly does the word bubble mean? If markets are efficient, there shouldn't really be bubbles that are irrational. That is, there shouldn't be a point where it's obvious prices have to fall. Now, in retrospect, a lot of people believe that when American housing prices went up so high to 2006, they were clearly overvalued and obviously had to fall back to reality. On the other hand, if you look at some other English-speaking countries, you'll see that Ireland, by the way, the US line, I've got to get my glasses. Is it the green one or the, I guess it's the blue line. And Ireland did have this big downturn. So here's the US with a small recovery in Ireland. But 4 other English-speaking countries that also had big run-ups in house prices, Australia, Canada, New Zealand, and Britain, they never crashed. they're still up at high levels. If you look at more countries, see the same sort of pattern. Some went up and leveled off, some went up and went higher, a few went down. So it's not necessarily the case that what goes up has to go down. Partly, probably, there were irrational decisions in the U.S. housing market in retrospect, but I think the severity of the recession in the U.S. also contributed to the downturn. Now, if you look at the unemployment rate, what you see is that we had 2 years and 3 months of declining housing production. Look at the data from over 2 million starts at an annual rate to about 1 million starts by April 2008. In that 27-month period, the unemployment rate barely budged. In fact, 5% is considered roughly full employment. Then we had another decline during the Great Recession, which was actually smaller than the first one, and unemployment doubled to 10%. Why did unemployment rise so much more in the second period? Because during the initial decline in housing, the rest of the economy was still growing because nominal GDP was still rising. So jobs lost in housing were being replaced by jobs in manufacturing, exports, services, and so on. But then when nominal GDP started falling sharply in the second half of 2008, that's when unemployment soared in all sorts of industries. This graph shows you that when the banking crisis was already pretty bad in April of 2008 due to the subprime mortgages, but the Great Recession made the estimated losses to the banking system go up a lot, and this is real GDP and CPI forecasts that were going down at the same time. So the severity of the Great Recession worsened the banking crisis. Now we finally get to nominal GDP. So I have this model I call the musical chairs model of the business cycle. And the way it works is this. It's actually a very simple concept. Nominal income, or nominal GDP, the dollar amount of income, is sort of the resources that we have to pay workers' salaries, right? And total wages and salaries are a big part of GDP, well over half. Now, the problem we have is that hourly wages tend to be kind of sticky or slow to adjust. So workers sign contract for a year to be paid at a certain hourly wage rate, typically. When nominal GDP falls suddenly, it need not have any real effect. This is a point worth emphasizing. I should probably go back and talk a little about those two graphs where you saw both nominal and real GDP decline at the same time. You might think, well, what do you expect? If we're spending less on goods and services, we would naturally have a recession and vice versa. No, there's no natural link between real and nominal GDP. In 2008, Zimbabwe had a big fall in real GDP, and their nominal GDP went up like 1 trillion-fold due to inflation. The two variables are not necessarily related at all. The reason they tend to be related in the short run in the United States is due to a quirk of the way our economy and other economies work, that wages and prices are a little bit sticky or slow to adjust in the short run. So here's what happens. When there's less nominal income and the hourly wage rate is about the same, there are fewer hours worked. It's that simple. It's like a game of musical chairs where when you stop the music, you pull away a couple chairs, a couple of the contestants will be sitting on the floor. If you suddenly pull away a certain percentage of nominal GDP, some workers will be unemployed. Between the middle of 2008 and the middle of 2009, nominal GDP fell about 4%. That doesn't sound like very much, but people usually expect about a 5% increase, or did back then. Now it's a little slower. So actually nominal GDP fell about 9% below the trend rate of growth. So both borrowers and workers signing contracts were anticipating income growth in aggregate much greater than they actually got in 2009. Okay? And when this happens, so what we have here is the red line is the unemployment rate in the United States. And the blue line is you take the hourly wage rate on average and you divide it by the nominal GDP per capita. And so since nominal GDP is in the denominator, when that falls, that ratio goes up. That's the blue line. Essentially, it's showing you that it's more costly to hire workers. Each worker's salary takes up a bigger percentage of nominal income available than before, so there's less money to hire as many workers. Very simple model. And a little bit on some recent data to give you a perspective. As you may know, while the US has done poorly since 2008, Europe has done even more poorly. The nominal GDP growth in Europe, as you can see, is well below the US. That's an extremely low rate for a 5-year period. And as far as one of the criticisms I often get when I talk about, boosting nominal GDP growth, won't this be inflationary? I would point out that both in the US and even more in the Eurozone, inflation is actually running a little bit below the target. So that actually is not the issue right now. I know that's a counterintuitive idea given all it seems like the Fed has done, lowering interest rates, QE, and so on. But the way monetary policy works, it's kind of like an Alice in Wonderland world where things are often upside down from what they appear. The country that's probably done the least in terms of like QE and so on is Australia. And they've had the fastest growth in nominal GDP and the highest interest rates among the major developed countries. Now, why is that? Well, here's what happens. When you have a policy that's too contractionary for the needs of the economy will go into a deep slump with falling inflation, possibly even deflation, as in Japan. When that happens, market interest rates will naturally fall, sometimes to zero. At zero interest rates, banks will just sit on a lot of excess reserves. So the central bank will pump money into the banking system, and it will just sit there, not circulating in the economy. The low interest rates and all the money pumped into the banking system will look like easy money, but it's more of a defense mechanism by the central bank, trying to prevent the Great Recession from being the Great Depression, essentially. Australia did not have a recession this time around, hasn't had one since 1991. Their nominal, I think I have some data on that coming up. Let me skip ahead a little bit. They did actually slow during the global crisis of 2008, but if you take a longer span of time, you'll notice that 2006 to 2012, they were still on track with their nominal growth, which is faster than other developed countries because they have more population growth and so on. So Australia never hit the zero interest rate. They had a healthier economy, and the central bank was able to keep nominal GDP growing at their historical trend rate. Okay, I'm going to just back up a second here. Here's the points I would like to emphasize. Stabilize nominal GDP growth in order to achieve these objectives. Number one, labor market stability. So that's very important. We'd like to sort of prevent these severe recessions where we have mass unemployment. Number two, credit market stability. The same sort of musical chairs analogy applies there. If people have borrowed a lot of money, anticipating a certain income they'll have in the future, and the income comes in collectively much lower than was expected, there'll tend to be a debt crisis. It's not coincidence that other cases of falling nominal GDP, like America in the early 30s, debt crisis, global debt crisis, in fact. Argentina, early 2000s, debt crisis with falling nominal GDP. This time around, falling nominal GDP, debt crisis in America, also debt crisis in Europe. Now, the way it plays out, it manifests itself often in different ways. So, for instance, in the United States, we had the subprime fiasco, I'll call it, which I believe would have occurred even with stable growth in nominal GDP. I think there were other mistakes made. So even if we hadn't had a bad recession, we would have the subprime debt crisis. But the Great Recession made the debt crisis spread to many other types of assets. Other mortgages, better mortgages, commercial loans, developer loans, and so on. Many banks that failed not because of mortgages, but loans to business developers that went bad. In Europe, the equivalent of the subprime fiasco was, let's say, Greek sovereign debt. Greece overborrowed, and even in normal times, Greece would have had debt problems. But some of the other countries that were drawn into the crisis, although they didn't have optimal fiscal policies, probably wouldn't have reached crisis stage if not for the Great Recession. So that huge slowdown in nominal GDP growth in Europe tipped some of them over the edge from being just stagnating a little bit to a crisis situation. And what I think happens is when these crises play out, people naturally think that whatever is occurring at the beginning is just getting worse and worse. as if someone has a cold and it's turning into a worse and worse cold. But a better analogy would be like someone that gets a cold, a viral infection, and it turns into pneumonia, which needs treatment by antibiotics or something. What I'm arguing here is we had sort of low-level problems in both Europe and the United States, and the failures of monetary policy turned it into a qualitatively different problem that needed a qualitatively different solution. So I'm not saying the standard view of the early stages of the crisis is wrong. Many of the things that people talk about that are wrong with both US and European policy are correct, but this is also important, monetary policy. George's name is right here, I see. So a lot of the problems that we tend to associate with inflation are actually better dealt with by controlling nominal GDP growth at a steady rate of growth. Things like debtor creditor unfairness due to unexpected rises or falls in inflation are actually more closely correlated with movements in nominal GDP growth. Another thing I would point out is the so-called bias against bias against savers due to the taxation of capital income. That's the returns on capital income are more closely correlated with nominal GDP growth. So if that becomes higher, we tax capital more highly, and that, of course, punishes savings and investment. Fourth point, statist policies, and I assume almost everybody in this room is opposed to statist policies, tend to thrive when nominal GDP falls. Now, why is that? Because monetary policy, as I've been trying to show you, works at sort of an invisible way. It doesn't look like tight money when it's happening because you see the low interest rates. So the public and even many economists say, no, monetary policy did not cause the crisis. It was caused by the failures of capitalism. We heard this in the early 1930s. Only with Milton Friedman and Anna Schwartz in the 60s did we begin to reevaluate what actually went wrong in the 30s. But at the time, that led to a lot of statist policies that were counterproductive and actually slowed the recovery. The only thing the FDR did to speed up the recovery was to devalue the dollar. That did boost monetary policy, more expansionary. Everything else he did slowed the recovery. Argentina, same story. Argentina was actually doing some promising free market reforms in the early 1990s. They got faster growth, but the Achilles heel of their program was they got locked into an overvalued dollar on the currency board when other countries were devaluing in the late 90s crisis. That pushed Argentina into recession. It tended to discredit capitalism in Argentina, and they swung far to the left and again put in a lot of counterproductive statist policies. This time around, we saw bailouts of automakers, banks, all this stuff going on, and of course all the policies in the recent years in the US under the Obama administration. But there's this perception when nominal GDP falls that it's a failure of capitalism when actually it's a failure of monetary policy. Conversely, when there is fairly steady growth in nominal GDP, like in the 90s, even the more left-wing party in the United States, the Democrats, were more moderate in their views of economics. They were more open to things like welfare reform and stuff because it seemed like jobs were there for people that would be reformed out of the welfare program, let's say. Or free trade is easier to sell if there's not mass unemployment. Or not bailing out General Motors is easier to sell if you have 5% unemployment compared to 10% unemployment. So it's a more friendly environment for free market policies. So the policy implications here are stabilized nominal GDP growth. The policy of targeting the forecast, the analogy I use here is steering a ship. Let's say you were on an ocean liner and you're casually talking to the captain and said, when do you expect to reach New York? And the captain said, well, we expect to land in Boston in about 3 days. And you said, well, wait a minute, isn't this ship scheduled to go to New York? And the captain said, well, yes, but because of currents and wind conditions, we've kind of drifted off course, and now we're forecasting that we'll end up in Boston. You might ask the captain, why not adjust the steering so that the city that you forecast you'll end up in is the one that you want to end up in, your goal city, right? Believe it or not, central banks around the world, with a few exceptions, act like the captain that just drifts off course passively. They issue forecasts for inflation 1, 2, 3 years out that are different from where they want inflation to be. Well, this is if they're targeting inflation, let's say. Well, why wouldn't you adjust your policy then? Why in late 2008, when the Fed had such depressing views of where the economy went, wasn't it adjusting its policy more vigorously? Do you know that in the second half collapse I showed you, interest rates were above zero that whole time until mid-December? They weren't even at the zero bound when this was occurring. Now, Lars Svensson talks about using internal Fed forecasts. So he wants to make it so that the Fed, their internal economic forecasting unit, believes they'll hit the target. And if they are not expected to, adjust the policy instruments until you do expect to hit the target. My preference is use market forecasts because I trust them more than the Fed. By the way, the Fed's been overly optimistic about growth for like 5 years in a row. So they don't seem to be learning. But I'm actually working now on trying to create some nominal GDP futures markets as sort of a demonstration project. But really, I think that the Fed should actually create, it wouldn't cost the Fed very much money, a nominal GDP futures market just to get a sense of where the market thinks this key variable will be in a year or 2 years from now. That's an important piece of information for monetary policy. By the way, it's more important than inflation forecasts. And we know the Fed looks at inflation forecasts because they talk about tip spreads in their meetings, in the minutes of their meetings. So here you have policy that can have effects in the economy running into the trillions of dollars. The Fed is flying blind, unwilling to spend even a few $1 million to set up a prediction market to get the market forecast for nominal GDP, which is more of a monetary indicator than inflation. They just rely on the fact that we already have an inflation forecast from the TIPS market. So there's a real passivity here among policymakers, and they seem to just arrogantly feel their own internal forecasts are fine, and the market has nothing to tell them that's useful about nominal GDP. A perfect example of this occurred after Lehman failed in September 2008. Now, the meeting occurred 2 days later. You might think the Fed would have cut interest rates after Lehman failure. No, they left them unchanged at 2% that day. The minutes of the meeting indicated that they saw equal risks of recession and high inflation. Okay, I understand why they saw a risk of recession. We were already in one for 9 months. But what about this risk of high inflation? Well, it's true that looking back over the previous 12 months, inflation had been pretty high up until about July of 2008 because of a huge surge in oil prices. So yes, there had been an overshooting of inflation. Arguably, that's a problem. But if you're trying to target the forecast, that is, drive the car by looking down the road, not in the rearview mirror, what were the markets telling us going forward inflation was going to be? The 5-year tip spread was 1.23%. That's below the Fed's 2% target. And guess what? Over the next 5 years, I don't remember the exact number, but it's around 1.2 to 1.4 was the actual inflation rate over the next 5 years. Now, the markets don't always get it right, but in that case, if the Fed had looked at the market forecast, they would have made a more intelligent decision at a key point in the business cycle. The markets were looking ahead and seeing that below target inflation was coming, as well as recession. You put recession, below target inflation together, and you have a big drop in nominal GDP. Now, many conservatives like the gold standard. This is a complex debate because there's debates about what was the gold standard, which period do we want to look at. The problem I have here is that in the modern world, governments are inevitably involved in things. It's almost impossible to keep them out. So it's hard to know how a pure gold standard would work. Probably a pure gold standard would have worked better, for instance, in the early 30s than the actual gold standard we had. But here's something I would caution conservatives about. One of the criticisms of my ideas for like nominal GDP targeting is people will say, well, we can't trust the government with fiat money. Yeah, it's a good idea if you sketch it out, but it'll be corrupted in the political process. But I would argue that that could also happen to a gold standard. Like some of the decisions made in the early 30s were not consistent with the rules of the game of the gold standard, and that led to a much worse outcome than should have occurred. But the gold standard didn't really protect us against a major monetary policy mistake. The only thing the gold standard can really definitely protect us against is high inflation. So it will protect our money from losing a lot of value, and that's certainly true. But as I said, severe business cycles like the Depression of the 30s can lead to statist policies, and that should also be a big concern to conservatives. Well, I won't get into free banking here, I guess. Here's some other advantages. The futures approach that I've outlined would create a nominal GDP futures market, and then the futures market would essentially set monetary policy. So the money supply would automatically adjust until the market expected nominal GDP to grow along the path set by the government. It might be 3, 4, 5%, whatever. In that kind of regime, actually the market would be implicitly determining the money supply and interest rates. So a lot of conservatives don't like the idea of the Fed setting the interest rate. They think that should be the market that determines that. Well, if we had futures targeting, worked automatically to adjust the money supply to keep to the point where the market's expected on-target growth in nominal GDP, then essentially the market would be determining the money supply they thought would lead to successful policy, and the market would be determining the level of interest rates that they thought would lead to successful policy. Also, it's easier for the public to understand. The public doesn't understand inflation targeting, and a lot of economists don't know this. Ben Bernanke himself was shocked in 2010 when the core rate of inflation fell to 0.6, and he said, we have to do some stimulus to raise inflation. And of course, all you heard on the radio and TV was people complaining, the Fed says it's trying to raise your cost of living in the midst of this bad recession we're in. That doesn't make any sense to an ordinary person. Why? Because average people think of inflation as supply side inflation. That is, they think of their own income as fixed, but the cost of living going up. But the Fed was trying to create what economists would call demand side inflation. So not only was Ben Bernanke engaging in bad PR, but it was also inaccurate. Ben Bernanke didn't really want higher inflation. What he wanted is more nominal GDP growth, and he hoped most of that would be real GDP growth and as little as possible would be inflation. But because they've had this inflation target, they use the language of inflation targeting. Economists consider it symmetrical. More than 2% is bad, less than 2% is bad. You aim for 2. The public believes the Fed is just trying to keep inflation low, below 2, because the public thinks inflation is always a bad thing. So the signaling from the central bank just totally confuses the public with inflation targeting. With nominal GDP, it's different. Ben Bernanke could have said, we've noticed at the Fed that the American economy is more healthy when we have 4% growth in the total income of Americans each year. That seems to produce a healthy economy. So we're going to do some stimulus to try to get American incomes growing at 4% a year instead of the big drop we had in 2009. That would make sense to the average American. And then another advantage here, it can be combined with free banking. Again, I won't get into that today, but Bill Woolsey's done some papers on that. I believe that macroeconomics has to sort of join the 21st century. There's too much of economists playing the role of Nostradamus, trying to forecast all sorts of things. That's not what economists are good at. That's what markets are good at. Instead, what we should do is essentially start to think in terms of market forecasts as telling us what policies are expected to do. And that means when a new policy is announced, we basically know within 5 minutes everything we're ever going to know about that policy and whether it, quote, works. Let me give you an example. Suppose the policy is targeting inflation, and you announce a QE4, and the tip spread, which is the market's forecast of inflation, goes up from 1.7 to 1.9% on the news. That policy is likely to lead to an extra 0.2% of inflation. That's all we'll ever learn. Now, you might ask, well, wait, let's play it out and see what inflation turns out to be. Well, inflation could rise by more or less than that amount because of other factors that occur. After all, these are not other things. We can't hold other things equal, right? When we're doing policy, we're doing it in a very complex world. But the market's forecast of the likely effect of that policy is still, even at the end of the day, a year later, probably the best forecast we have of its independent effect. And so the markets, one reason I got into blogging in 2009 is I was looking at the markets and they were telling me that Obama's fiscal stimulus and the Fed's monetary policy combined were not going to produce an adequate path of nominal GDP. My personal view is fiscal stimulus basically doesn't work. But the monetary stimulus was not adequate, and I was getting that from the markets. And I think it turned out to be correct. The Fed was consistently disappointed. It would do QE1, then it would stop. It had done enough. Oops, we haven't done enough. Let's do QE2. All this back and forth. They weren't looking at market indicators. I've talked already about the scandal of them not having this futures market. It'd be very inexpensive to set up. Almost done here. Lessons for the left and the right. Here's Matt Iglesias, a very talented left-wing blogger. He says the Great Recession has revealed a lack of capacity for engaging in monetary issues to be a weakness on the progressive movement. Basically, the left ignored monetary policy almost entirely. They thought fiscal policy was the way to go, and it turned out fiscal policy was very ineffective. One quick example. At the beginning of 2008, we did a lot of what's called austerity. That is, we cut some government spending with the sequester. We raised income taxes. We raised the payroll tax by 2 percentage points. We did bring the deficit down significantly in 2013. The Keynesians said that's going to really slow the recovery. Well, during 2013, from the beginning to the end of the year, the real growth rate was considerably higher than 2012. As we market monitors said it would not slow the recovery. The reason we said it would not is at the end of 2012, the Fed did some stimulus, 2 programs, QE3 and forward guidance, expressly because they were worried about the austerity. Paul Krugman said in early 2013, 2013 will be a test of market monetarism, this idea that central bank policies essentially offset the effect of austerity. At the end of the year, of course, he walked away and he said, well, who thought it was going to be a test? Because we passed with flying colors. Growth actually sped up despite all this austerity, and it was because of the Fed's monetary stimulus. For conservatives especially, I would think monetary stimulus is much preferable to fiscal stimulus, which leads to higher taxes and spending over time. On the right, I think the mistake, and many, I'm a University of Chicago economist, many economists I really revere, like Alan Meltzer, I think made mistakes in forecasts by looking too much at the QE and assuming that the past relationship between money supply and inflation would hold. But at the zero bound, you can't really make that prediction. I don't think conservatives were paying enough attention to markets like tip spreads, which were telling us that inflation was likely to stay low. And I think that hurt the conservative movement over the last 6 years. Forecasts of high inflation that didn't pan out. Fortunately, the market monetarists, we were not making this kind of forecast. But by the way, you saw the same thing in the Depression. This quote at the end from Ralph Hawtrey, people crying, fire, fire, and Noah's flood. In the Great Depression, people were saying inflation's coming, because the Fed did QE in the Great Depression. Even under Herbert Hoover in 1932, they did some QE. And so this mistake, I'm sort of a student of the Great Depression, and I see sort of the same mistakes in interpreting what's going on occurring in recent years as occurred in the Great Depression. So I believe the Fed does basically what a consensus of macroeconomists wants done most of the time. So the consensus view has been among American economists that the Fed was doing it about right. So I blame the economics profession, not the bankers, for the Great Recession. I'll just end up with this imaginary conversation. Why do people always say it's natural to assume the Great Recession was caused by the financial crisis of 2008? Well, obviously because it looks as though the Great Recession was caused by the financial crisis of 2008. Well, what would it have looked like if it had been caused by Fed and ECB policy errors, which allowed nominal GDP to fall at the sharpest rate since 1938, especially during a time when banks were already stressed by the subprime fiasco and when the resources for repaying nominal debts come from nominal income. So if you replay the last 6 years and ask, what if Sumner's right, or what if money was tight and caused the fall in nominal GDP? What would we have expected to happen? In fact, if you go back to 2007, let's say before the recession, or 2006, and just put 50 macroeconomists in the room, conventional macroeconomists, and give them a crystal ball and show them that big drop in nominal GDP in 2008 and 9. And that's all you tell them. You say, here's what happened to nominal GDP. This is monetary policy. And there's no banking crisis. What do you think will happen to the real economy? Most of those economists would have predicted a severe recession looking at that path of nominal GDP. And, here's another analogy. People will tell me, the real problem is this or that. The real problem is our financial system. And no, there's more than one real problem. That's why the paper was titled, "The Real Problem is Nominal." Imagine you've got pneumonia and you're walking down the street to the hospital to be treated. Someone mugs you and stabs you on the way there. You're brought into the ER. And the doctor says, well, there's really no need to treat this person's knife wound because the patient's real problem is pneumonia. You'd probably ask for a different doctor, right? This is essentially what I'm trying to say here. Yes, there are many problems with the U.S. economy. There are structural problems. There are regulatory problems. We're not performing as well as we were even in the 90s, even ignoring monetary policy. I'm not saying monetary policy is the only problem, but it was a major problem, and it has ripple effects on our other policy failures in other areas, I believe. So that's what I would really encourage you to do, is to reevaluate this period and think about it from a different perspective. Thank you. And I'll take any questions you have, too. George.
Hey, Scott. One of the things, the issues that interest me a lot in light of your arguments is the difference between, what interests me is this, the difference between arguing that the Fed ought to have kept nominal GDP stable in the 2008 period,
Mm-hmm.
and arguing that the subsequent quantitative easing was worked, right? I completely agree that the Fed blew it in 2008 by letting nominal income collapse. But I have grave doubts about whether its attempts after the fact to make up for that mistake, a mistake that actually caused the zero-bound problem, along with paying interest on reserves, which of course was, I think, very ludicrous, that trying to make up for it with all the quantitative easing was rather like a cat chasing its own tail, having essentially gotten off to a wrong start to begin with. So I'd like you to comment a little bit more about what you see as the connection between what you're advocating and an endorsement of the actual quantitative easing that finally took place.
Let me clarify that I do not actually view quantitative easing as sort of like the right or appropriate policy. I argued it was better than nothing. And I do think, I will concede this point. So I think we both feel that the strongest argument I'm making is for 2008 and 9. And as each year goes by, my argument gets weaker. I do accept that. But let me give you a few pieces of information why I still think that some, quote, makeup, although not going all the way back to the old trend line, but some makeup was appropriate. One is that it seems like the U.S. economy is not as flexible as in, say, 1921. You know about that famous recession. There was a very deep recession in 1921. The government really didn't do much to fix the problem, but the economy recovered quite quickly in 1922. And for some reason, the U.S. economy doesn't seem to have the bounce back. It may be because of lots of regulatory changes and so on, or changes in the labor market, whatever. So I do sort of look a little bit at things like the unemployment rate. Like if unemployment had fallen quickly after nominal GDP started growing again, came quickly down to a reasonable level, I might have thought, well, there's not really much the Fed needs to do. Now, the unemployment rate itself can be a misleading indicator, so that's not a slam dunk. A second thing I would point to is that both the U.S. and Europe had roughly equal initial recessions. GDP fell about equal amounts in the US and Eurozone in 08-09. And we had very similar early recoveries between 09 and say 2011. That's an interesting, why is that interesting? Because after 2011, there was a sharp divergence. And it's, I think, possible to even point to the fact that the ECB tried to tighten in 2011. By the way, the ECB was not at the zero interest rate bound. They raised interest rates several times in 2011. And along the lines of what I was talking about earlier with interest rates, later in Europe, interest rates went back down to the zero bound as the European economy weakened. So here's what happened. Deep slumps in both places, initial recoveries. The US continued to gradually recover, whereas Europe went into a double dip recession after 2011. So I think there's at least some argument that the ECB is partly to blame for that. Now, I do concede that when you get further away from the obvious mistakes like 2008-09, it's less clear what should be done. And, you know, I seem like a very opinionated economist, but for about 20 years before the Great Recession, I mostly didn't have very strong views on monetary policy because it wasn't clear exactly what the Fed was trying to do, but they seemed to be doing a fairly reasonable job. And I don't like to get put in a position of trying to sort of micromanage every decision at the Fed. We don't really know whether Fed policy is appropriate until we know what their long-term objective is, and that's not clearly spelled out. They have this vague dual mandate, but if they actually said, we want 4% nominal GDP growth, that's our target path, we hope it'll be 2% real growth, 2% inflation, then I could offer an opinion maybe on whether money is too easy or too tight right now. It's much harder for me to do so not knowing how they'll react to future events, like what track are they trying to hit? And so in early 2009, it was just so obvious to all of us that we'd fallen too sharply, a mistake was made in 2008, that I could very confidently say, yes, we need a lot of stimulus to offset the mistake that's been made. As we recover, it becomes much less clear where we should go, but it would be much clearer if they had a clear policy path laid out. And unfortunately, they don't, partly I think because they don't agree among themselves entirely on exactly which path they want to follow. So they have sort of a rough agreement on some general contours, like the 2% inflation number, but how that fits in with their other side of the dual mandate, the employment, is very vague and differs between the liberals and conservatives on the FOMC. So,
Salim Firth from the Heritage Foundation. So I'm a little curious if you could go into more about what the mechanism is that you see as the link between nominal and real GDP. I mean, there's sort of this obvious mathematical relationship. Real is constructed out of nominal and inflation. And so I guess I could imagine a set of policies. You might say, well, we want to have inflation react to changes in real GDP with some parameter. And you're setting a parameter equal to 1. So 1% less real GDP growth, then we want 1% more inflation, so we get the stable nominal GDP growth. Why 1 and not 2 or 0.5 or something else? Or would those all be good, but 1 is easier to explain and to you know, it's clearer. And beyond the sticky prices, are there, you know, say on the upside, say we had structural reforms and higher than expected real GDP growth, would lower inflation than usual in a case where real growth is higher be beneficial in some way? I don't see the obvious mechanism there.
okay, George could probably answer this better than me, but I'll try. So most economists think of inflation and real GDP growth as two real things that get added together to produce this artificial nominal GDP concept. I think George and I think of nominal GDP as more the real thing. And the way that's partitioned into inflation and real growth, first of all, there's all sorts of issues about how bureaucrats do this. It's very, when you look at the details, it's not clear how it should even be done. It's sort of arbitrary. But beyond that, I would say this. We believe that a lot of the sort of problems that you associate with movements in real GDP and inflation are better thought of in terms of nominal GDP. For instance, some movements in real GDP are appropriate. Responses to shocks in the economy, like supply shocks. And we believe that nominal GDP growth will likely lead to those appropriate movements in real GDP, okay? Let me give you one example of why that is. I personally believe that a lot of the inappropriate movements in output are caused by the addition of not just the supply shock that's inevitable, but beyond that, mass unemployment that makes it worse. Okay, so for instance, let's say we overbuild housing a lot. There's inevitably going to be a price to pay as those workers have to shift over into other industries, be retrained and so on, and we're going to have a little bit of stagnation after the housing bubble no matter what. That's an appropriate slowdown in real GDP growth. But what you don't want to do is have a situation where you get a lot of unnecessary unemployment in other industries. Now, how do you minimize that unnecessary unemployment? Well, if nominal income is the total resources available to pay workers, and wages in nominal terms are very sticky, they tend to rise year to year at roughly the same rate, then if you keep the path of nominal income growing at a steady rate, you're going to approximately minimize undesirable employment fluctuations. So you'll get actually a better outcome for real GDP, paradoxically, than if you tried to artificially hold real GDP constant. Same thing with inflation. I mentioned in the talk that problems associated with inflation are often more accurately described as problems that occur because of fluctuations in nominal income in the economy. So we tend to think that nominal income is more like the real thing. It can be more objectively measured by the government, and the stability of nominal GDP growth will actually allow inflation of real GDP to be a little bit unstable individually, but in an appropriate way for meeting these deeper goals of policy. Does that make some sense? Okay. Back.
Hi, Curtis Dubay, economist here at Heritage. You touched on it a little bit during your presentation, but I'm just curious what your thoughts are on the secular stagnation theory put forth by Larry Summers.
I'm not a big fan of that secular stagnation theory. It's more demand side, and as you know, he proposes fiscal stimulus as a way out of that. I don't think that will work. I do think there is a slowdown in the trend rate of growth, both in the US and other developed countries. And I'm not quite sure why that is. Here's some possibilities. There does seem to be somewhat of a slowdown in a population, especially labor force growth in the US. Working age population is growing more slowly now in the US than before. True in Europe and Japan as well. Maybe some slowdown in productivity. It's never clear whether that's just happening for reasons on its own or if it reflects bad policies out of the government. But here's one thing I would point out. During this so-called recovery the U.S. has had over the last 5 years, real GDP has grown only a little over 2% a year. And the unemployment rate has been coming down fast from 10% to 5.8. Now, when the unemployment rate stops falling, growth is likely to slow even further. So I'm actually, in my blog, I'm predicting that the trend rate of growth is only a little over 1% in the United States for real GDP. It's possible that better policies can boost that somewhat, but I'm a little bit skeptical that it's 100% policy. It may be partly other things going on in the global economy. And again, it is kind of a global phenomenon. We always have to look beyond just the United States. It's a large country, but when you're seeing similar events take place in Japan and Western Europe and elsewhere, that does suggest there's something fairly profound going on in terms of growth slowdown. And by the way, the slowdown is worse in Europe, which is one point in favor of it being partly policy. Europe is a little more socialistic than the United States and has a lower per capita GDP than the US, about 25, 30% lower, but it's even getting worse. Year by year, that gap is even widening. So, I mean, that's a very strong argument against people on the left that want to move us towards the European model. It's not so much that per capita income in France is only 70% of the US right now, it's that that number is going down, even from the 70% figure. So that's about all I can say. But he believes it can be solved. I believe it's more a supply side issue, population growth, technology, government regulations, and so on. He believes it can be solved by just demand stimulus, and I don't buy that at all. The U.S. is a particularly inefficient country at building infrastructure, which is what he wants to do. It takes a long time, and it's like, as you may know, it costs like 3 times as much money here to build a subway line as in Europe, even with the same wages in Europe. So I think it's a pipe dream to think that infrastructure spending is going to rescue our economy, especially government infrastructure.
Hi, Chris Rumke at Capital International. I'd like to thank you and Heritage for the best lecture on economics I've heard in quite some time, so that's very
thank you.
refreshing. A couple of quick points. I was teaching economics in New York City in 2005, and I asked my undergraduate students, hands up, how many people think that the current rate of nominal debt expenditures of 106% spending, of 106% of income is sustainable? Because the average person was spending 6% more than they're actually earning. And all the hands went, oh, that can't possibly happen. So we're sort of headed for a slowdown anyway on that. The other thing is, if look at the velocity of money has collapsed over the last 10 years. And you could make a really good argument that the Fed stimulus was just simply to fill that hole. It's just fascinating. You look at Fred and you just see that velocity of money just collapsing. And a big part of it is, you touched on this, the increasing regulation, Dodd-Frank, and the ability for small businesses to get loans has just completely gone away. And what you think of the potential effort, as Ben Bernanke complained recently that he couldn't get a mortgage, the effort to drop the 20% requirement to get a home mortgage down payment to 3 and 5% will do to the economy. And you can look at the real estate ETFs over last year up 26%. It's kind of a pretty good indication how that may just yank the economy up very quickly when that changes. If you care to comment on any of those, thank you.
Yeah, so I kind of have mixed feelings on the whole banking picture. In the ideal world, I'd prefer sort of like no government involvement in banking at all. But that also means like no FDIC, no too big to fail, no Fannie and Freddie. There's a lot of government involvement that actually encourages risk-taking, okay? And so then the next question is, well, given we have all these things that one economist, I think, said, any bank that isn't taking socially excessive risk is not doing its job for its stockholders. Because given all this deposit insurance and too big to fail, it biases the system in such a way that if you act in the interest of your stockholders, you'll take risks that's beyond what's socially optimal. So given all this all this moral hazard, I do think there is some case for regulation, and I don't know the best way to do this. Some people talk about capital requirements or different types of deposits, like insured deposits and uninsured, and the uninsured ones can make any kind of loans, and the insured deposits have to make loans that are relatively safe. So I'm going to have to defer to people that know more about the financial system than me, but I do think it's a difficult problem because one set of policy errors, protecting people against their losses, creates excessive risk-taking. That leads to laws like Dodd-Frank, which are very complex, costly, and probably don't attack the root problem anyway, but just make the whole system much more ineffective and costly. So we pile one mistake on another. I would sort of try to disentangle that, but I don't know the best way to exactly disentangle the mess we're in now.
One more question, and we have time for one more.
Yeah.
Institutionally, do you think the FOMC would be willing to make a shift in the way they design policy without a change in their mandate? Or do you think that
Good question.
Congress has to do
First
something?
of all, nominal GDP is completely consistent with their dual mandate, so they could do this any moment, all right? Now, let me say something that might surprise you. I have a certain sympathy with the Fed not just jumping right on board nominal GDP targeting, and this is the argument I would make. It was only about 2 or 3 years ago, I think, where the Fed actually clearly, officially spelled out their 2% inflation target. If you do that and then immediately tear it up and say, oops, no, we're going to do something else, but we promise to keep this one forever, they're going to lose some credibility. So personally, of course, I would like nominal GDP targeting, but I think the more plausible track is that it gets studied. It's certainly being studied more in academia than 5 years ago. and there's more people talking about it, but I think it has to sort of be studied for a few more years or even a couple decades in academia to where people are comfortable with the idea so they can really make the leap. And they might want to make the leap in stages, like use nominal GDP initially as an intermediate target. Sort of like, okay, we still have this 2% inflation goal, and long-term we'll try to hit that, but in the meantime, we'll cushion blows in nominal GDP and adjust the path a little to try to keep 2%. And if they use it for a while as an intermediate target, get comfortable with it, then they could make the final leap and just discard the inflation target entirely. But for credibility reasons, I don't think it's reasonable to think that they could do it right now. But yes, the mandate does allow that because it's got real growth and inflation combined in the nominal GDP number. So that's consistent with the dual mandate. Does that answer your question?
Yeah,
Yeah, okay.
Thanks very much, guys. Thank you, guys.
Thank you.
We'll try to get Scott back for the end federal deposit insurance event that we're having next year. No.
I love that. Yeah.
Thanks a lot.
Okay, thank you.